All right. Good morning, everybody. We got economic events on the table today that's causing them to hedge in front of those events. Got some market maker moves. Mixed bag around the world. We did hear from China that said at this point, with the tariffs as high as they are, if the tariffs go up any higher against them, they won't retaliate because they'll just be ignoring it. Kind of goes to the idea that anything else any higher than its current level, it's already as impacted as it could be impacted, and they're like, there's no reason for us to retaliate. So on the one hand, I suppose, it's not going to get any worse on the China front, no matter how much higher the tariffs go against China with that statement. So we've kind of hit a plateau. As long as the other nations don't retaliate, then we don't have to retaliate because they retaliated, then we could see more normalization. And that leads us back to the S&P with the low that we put in being the low for now, till something changes. We got PPI at 8:30. Then we've got some Feds chipping their teeth. In the afternoon, we're going to see a little data, and that's really, these afternoon ones today, they're not really a big deal, so we shouldn't have any impact from them. We say that, but never quite know for sure, right? And I've never been one to say, well, we can just ignore this. They're not likely to have any issue. Still, watch the clock. Keep your eye out on new hours because new hours bring flow. And of course, we can always get headlines from tweets, or something could come out of the House and Senate. It's a Friday, so we could get a data dump. Know what you own. Be mindful of headlines. This Friday kicks off the earnings season. We've already heard from Wells Fargo and JP Morgan. Banks set the tone. So we really want to pay particular attention to what the banks have to say over the next week, because it's very likely going to give us clues and insight for the rest of the earnings season and what's in store for us. It's a bit of a wonky chart here, but we got growth versus value here. And to me, this is something that I look at every day. I don't sit just staring at it all the time, but I do pay attention to it. On the left side is a growth versus value that is really useful for trading the Mag 7, or those hyperscalers or mega market caps. And we're kind of stalled out against this 2.0 level. But if we look at this other one, which I find useful more from a capital rotation and a truer sense of growth versus value, we can see that growth is outperforming. Now, if you're not familiar with this logic, it's the idea that tech and growth and taking risks is generally seen in a positive market environment, right? If the economy is bad, if inflation is high, if companies are laying people off, employment's rising, we'll see defensive sectors do better, and we'll see value stocks do better. But if that's turning around, if people are willing to take risks, if they're spending money, we'll see growth do better. And we're seeing growth begin to outperform. What's interesting when we put them side by side is we can see growth is beginning to outperform, but it's not necessarily coming from the Mag 7, which is what we had after we came out of that bear market in 2022, right? It was really just the Mag 7 doing the heavy lifting, and the rest of the market was either dragging its feet, kicking and screaming, or was trying to participate, but really just couldn't match the flows, right? We had all that CapEx tied into AI and data centers and just massive amounts of money spent on chips. And they were just fueling each other in this perpetual motion machine. And it just kept running higher, carrying the rest of the market. This growth versus value is a little different. It's not coming from the Mag 7 per se, but from others. So it's more spread out, which is what we've wanted for a long time. You don't want an entire market rally fueled solely by the Mag 7, right? Want it to spread out, get that rising tide to lift all boats. It's a good start. It does add into the idea that we've got a low in the S&P. We don't know if it's going to be the low yet, but we have a solid low put in. We've got growth winking a little bit over value. And it's not just from the hyperscalers or the Mag 7. Take what we can get, right? We got the put wall 47.37. It's a long ways off. We would need a new low on the week to get there. Otherwise, we have to get through the 10-week to see the zero gamma volatility trigger and then the call wall. I'm not saying we can't get through that 10-week, but that's a pretty tall ask. And we really don't have anything that can give us the juice to get there. Yes, we have economic data this morning, and potentially it could do it. But, you look at things this morning and kind of ask, does that one economic data point have enough push to help people forget about all the tariff threats and the rhetoric and, the possible issues with the debt ceiling, all these things right in front of a weekend? Why would they want to carry all that risk into the weekend? So I find it hard to believe we're going to get through the 10-week unless we get more headlines, something on the tariffs that really juice the market and push us through that 10. Otherwise, I think we could get through it, and that likely caps us out for the week. Two things to focus on right now. We have our current week. This is a weekly chart that we're looking at. And we have the high and the low of our current week, and the midpoint of it is 51.80. If we're focused on the low that we have, just zoom out here, this low that we put in, if this is going to be a solid low that may last for a bit, may even be the low, we need to stay above this 50% mark and close this week greater than 50%. Then we've got another thing that we need to focus on, right? So that's 51.80-ish, just drop a line there. Then we've got last week's low. So this midpoint is about this low and whether or not we're putting in a base and whether or not that base is solid. If we want to talk about continuing the move up, we've got to get through this low, this midpoint here, 54.23. So two different levels of interest that we have to work through at this point. We don't have to close above that today. And of course, today being the end of the week, we don't have to end the week above this level. But going into next week, we do want to get above that level and close above it. Otherwise, we're going to just be putting in a complex bottom or a basing pattern here, which very likely could allow us to set a lower wick from here. I mentioned it the other day that we want to see a higher low put in. If we're using OCR style analysis, then we've already got one higher low put in. Now we've pulled back and we've got this little candle. So if we don't come back down and break this low and we stay inside that range or go higher, then we'll be able to validate that as another higher low. These are really big broken candles, right? This entire thing is just, they're just big, massive bars. So we could end up, with crazy stuff like these two. And even something like this, right? It doesn't have to just come right back out of it in normal, clean price action, because this is not normal price action, right? But if it helps, turn it into a line chart. And focus on the idea that we've got a low and we want to see price continue to stay above that low. And now that we've pulled back, run higher and set a higher low. It's really as simple as that. We don't want to see a new low at this point. They are hedging this morning in front of the event. There's a couple of things that they could be hedging, but it's very likely the 8:30 data that they're hedging. I really don't think they're too worried about Williams. And the 10 a.m. data could be the issue. They absolutely could be hedging that, but it's much more likely that it's the PPI. So after 8:30, if we don't see the market maker move begin to decline and instead it stays where it is or it begins to go even higher, then we'll know it wasn't the 8:30 print, it was the 10 a.m. print, right? So it'll be one of those two. If you're not on Thinkorswim and you don't have the market maker move, as long as you have options, you can see this for yourself. What you want to do is go to the options on the ES and look at the front end. We can see right now that the front end is trading at a 61 and the next expiration out is trading at a 54. That's what they call a market maker move. And it just says they're hedging in the out of the money options. They're buying a lot of 0-day out of the money options to add additional protection to some trade this morning, to some position. And they would not spend this money if they didn't have to, if they weren't worried or concerned about it, right? Because this is all cost for them. This isn't like when retail trades a hedge. A lot of times we just do it to make some more money. It's all cost for them. We haven't hit the ADR half on either side, but with the violence we've seen on a day-to-day basis, it would be shocking or surprising today for us not to hit one side or the other, possibly both. Just because we haven't hit one yet doesn't mean we can't. And since that's our typical range, then it's what we want to focus on. I did mention how it's Friday and it's hard to see why anybody would want to accept more risk going into the weekend. If today is going to be one of those sideways days where we hill and we just chop about, we go meekly and quietly into the close, then we won't hit either side other than from the whiplash we get during the economic data at 8:30, because we could get a big liquidity bar, big wicks on each side, just a lot of jumping around, and then we close near where we opened on that 5-minute bar. And then we spend the rest of the day chopping in between these two red lines. That's absolutely possible today, right? It doesn't owe us a rally. There's no reason for us to have a big sell-off. And it's just very likely that we go into the close. And this is almost a 200-point range. I know it doesn't seem like much, but It's 190 or 189 points. That's more than enough room for the ES to just stay in that range and go into the close for the Friday. And at this point, that's the base case argument for today, that's what we're going to do. Now, with that in mind, it doesn't mean that we can't wick beyond the edges of what we've already got. So the way that this is drawn, these aren't extending into last night. If I was on TradingView, then we could say it already hit. So we could take that, right? Fine, we hit it. Then the idea that we won't hit either side is taken off the table. And that means that we can wick above this higher one. We can wick below this lower one and maybe begin to build a little bit of a megaphone pattern, right? The way that megaphone pattern goes is it just continues to extend a little bit higher and a little bit lower until finally something breaks. So we could get that today. Base case, though, is that we have no reason to go anywhere. And if we get outside of these red lines, if we get outside of the top, then we've got the RTH of yesterday to worry about, and then all of yesterday's high to worry about, which takes us up to 55.29. And on the downside, it would be staying inside of yesterday's range on this low end, and then getting out of that and hitting 51.11, the yellow line down here. But we've got almost a 200-point range in that red box, and I don't, at this point, see any reason that we would leave it on a Friday unless we get headlines. We are within the week's pivot channel. The channel itself doesn't really bother us that much. It's just the idea of whether we're above or below the weekly pivot. And we've crossed back and forth through it enough that we wouldn't expect it to provide any form of support or resistance. It's not useful or valuable at this point at all, not helpful. Side of it is today's floor pivot. Today's floor pivot is a little higher than yesterday's. We would consider that bullish, but price opened underneath it. We would consider that bearish. Those two kind of cancel each other out. Today's channel is really narrow compared to yesterday's channel. A narrow channel implies that if we do break out, we likely could grow legs and that we could really run. The narrow part of our range today is 200 points. The wider part of our range today is 380 something points. So if we're going to, quote, break out and run, we would have to get all the way to the edge of one of these two and then break out beyond yesterday's range and then continue to run even farther than that. It would have to be some really big headline news, something really big. So while I won't say it's not possible because price can do whatever it wants, I don't see the reason for it. And it would have to be shock and awe, something really that the market didn't see coming. Looking at the volume profile for the week, this is just an absolute mess. We've got two high distribution zones, but otherwise it's really starting to shape up more like a classic D shape than anything else. There's no real insight into any structural level here other than right below us around that 52.65 or 52.67 area, something like that. Once we get below that, it starts to get shallow and we can move through shallow zones relatively easy down into 50.26. I'd call it 50.32 cog line, but either way, down into the lower point of control. 10-day, 30-minute volume profile with TPO. Point of control is still in the 5630 area. It's up here. We've got to take these candles out. It's what we were talking about yesterday with it shifting down just a little bit, but not really moving too far. We got that shift. And now we're not going to get into those candles to move it. We need to build out a new volume zone somewhere else. If we get to messing with the high on the week, then we could build it out around this zone here. And that's for today if we run up there and start building it out. Otherwise, if we drift back down a little bit, we could build out that zone there. It's about where we are, 5,300. Below that, we've got a couple of these other ones that we could build out. That would take time and it would take a bigger move. We'd have to break through Thursday's low and really start to stretch to the downside and get into some of those other ones. It's more likely that we'll build out the high of the week, and we could even start to do it next week, right? Because we've got to get into these candles next week. That gives us time. So we could build out next week this high on the week and or fade down a little bit and build out that one. I think either one of those two is more likely. Best case scenario is that we get above it before it gets moved, right? So say we build out this level from Friday and then we get above 5,500 and then the point of control gets moved down and it's underneath us. That'd be the best case scenario. We still got the VPOC that we put in on Wednesday. No new one for Thursday. And this morning, really not a lot of insight on our own profile. We're just building it out, waiting on data. It's Friday, so we have next week's range already projected. It's not set in stone yet, but we can use what we have. So take this week's range and we lay it against next week's range. And we can see that next week is a little smaller than this week, not by much. And these ranges are based on time and volatility. The third Friday of the month is OPEX, but this month we have Good Friday. So there's a day missing from next week. So these 2 weeks are not equal because this week is a 5-day measurement and next week is a 4-day measurement. So while this next week is missing a little bit of range here, it's very likely because it's missing 1 day. That 1 day didn't account for very much range. So it's hard to compare volatility between 1 week and the next if we don't have an equal amount of days between 1 week and the next. I would say next week is pricing in a lot of volatility. We can't really see that because we're missing that 1 day. But it sure feels like it's pricing in a lot of volatility if it's that wide and we're only missing a single day. The thing about pricing in volatility is it's tricky and it's subtle. If next week was an FOMC week, for an example, you would likely believe, oh, next week's FOMC, they're pumping in volatility because of FOMC. No, that's not what they would do. It would be narrower because before we go into FOMC, a lot of times we go sideways. FOMC and other large events are volatility suppressing, and it would be a narrower range in front of a big event. So whatever volatility they're pricing in here, it's not something like FOMC, CPI, PPI, which we're dealing with those this week anyways. What we've got next week is a short week, and we've got OPEX. And apparently that's enough to juice the market for next week. You can see we're still hanging out around that 10-day now. We are 1% below the 10-day The zone that we generally believe to be a bit of a magnet is closer to 0.5%, so we're not close enough to it to get drawn into it. This is a good step towards healing. I know it's not necessarily the typical language that you'd hear, but the market is damaged, it's broken, and it needs to heal itself. And we can do that in a correction. Now, a correction in price is what everybody's used to, but you can still get a correction through time. That would allow the market to heal. It would allow to put in a stronger base, and it would just give the market that time that it needs to heal. The main takeaway of looking at that 10-day at this point is that we're not overbought, we're not oversold. It doesn't owe us any sort of mean reversion or big move at this point. We haven't gone too far too fast. Looking at where we are in relation to the 10-week, we're still underneath it more than 5%. The expectation is we would continue to move towards it now that we've gotten so far away from it. And so, yeah, we're more than 5% away, but it would be more likely that we hold the line here or that we get closer to that 10-week. So while it's technically possible for us to start pushing away from the 10-week again, even from here, it's not likely. It's possible, but it's not probable. Looking at things that are down this morning, nat gas. That's it. That's what we got. Nat gas and bonds. We got a lot of things that aren't hitting the radar at all. Bunch of zeros here. Then if we look at what's up, things that are up at least 0.5% or more. Technology, semiconductors, not Texas Instruments apparently, but uranium, China, gold, gold miners, Bitcoin, and then China again. Now, Bitcoin is one of those assets that we lump in pure risk, right? There's risky, and then there's just pure risk. And whether or not you like Bitcoin, whether you trade Bitcoin is irrelevant. Its value as a tool or a gauge or an indicator of risk and people willing to take risk, I haven't found anything better, right? So it is the best tool to define people's willingness to accept risk. When Bitcoin is up, I pay attention to it. Now, of course, you do have to worry about things like mean reversion. If Bitcoin fell 35% in 3 days and then it was up 10%, I wouldn't be very excited about it because it's just bouncing back after falling 30%. So we do got to put it into context when we see that it's up or that it's down. This morning it's up 3.25, but it was down almost 9% over 5 days. So sure, we're getting a little bump this morning. Definitely needs some follow through. And it's likely we're going to see things that are getting a bump this morning all over the place. We still have to heal, and we still have to get beyond the resistance that is overhead. Otherwise, a lot of this stuff that is bouncing is just a bounce into resistance. Then it's going to roll over and check its own low and or make new lows. With earnings kicking off, we got banks up this morning. And then, of course, China again. Biotechnology, more generically speaking, XLF. Cloud computing. Now, with cloud computing, a lot of times in the pre-market, we don't get much out of this. So we can see two little algo prints here. I wouldn't read too much into that yet. If it was developing out some candles, say all these pre-market candles, we've actually got something here that we can look at. that would be different. But cloud as an ETF generally doesn't give us very much in the pre-market. So don't read much into that yet. Once we get into the open, if we're still up in cloud, yeah, that's great. But don't count your chickens before they hatch. Precious metals, silver, gold miners, all up. And that's been a theme too, by the way, right? It's something that was really standing out this week is they're doing great. Even getting a little bit of a move back in uranium, but this has been a defeated space for a while. You can see it's a very nice downtrend. So just because we're getting a little bit of an up move here on uranium doesn't mean we're turning the corner and that everything's okay again. It's a nice start to all of this, right? Today, with all this green, and this week with that low that we put in, so far, it's a really nice start. But just remember, you put this on a line graph or a line chart, you realize the low that we've put in so far, we have to put in a higher low, and then we have to put in a higher high again, right? It's called a full set if you're looking for a trend. When you are measuring a trend to the upside or the downside, you need 2 higher highs and 2 higher lows for an upside move. That's a full set. Right now, if I put this on a line chart, we've only got the low. We haven't pulled back and put in that higher low yet at all. So we don't have a full set. We don't have a trend. We don't have anything yet. We certainly aren't breaking previous highs and trying to set new highs. Got a lot of work to do. And this isn't just in the ES. You take it on the road and look at equities, look at whatever you want. That's going to be the benchmark for turning all of this around, is that we put in a base, we establish a low, and then we begin to work off of that, heal and climb. That's what I got for you guys. Watch the clock. Be careful. Be safe. Have a good weekend. I'll see you.